Hi all. Um, Welcome. Just want to make sure that my volume is on. It is. Um, put this out of the way. Okay, so we have three slide decks to get through this week. I will make each one a separate recording so you don't have to try and watch them all in one sitting. Okay. I'm trying to make it easier on you, not more painful. If you are seeing this recording on Monday morning, please remember that it's check-in day. So you need to be logged into an ECPI computer with your camera on. It takes about 15 to 30 minutes for the system to update and show you as online. So the closer to 8 a.m. you log in, the better. Um, because that means that, you'll have plenty of time for it to register and acknowledge you. I can check off you're cleared for this check-in day, okay? I don't think we have any other announcements. I apologize in advance. My parrot's in the background going absolutely berserk. I hope that's not too distracting. Anyway, if you're having any issues with any of the material, please reach out to me for assistance. Again, I will not penalize you if you turn in work late, but I will start plugging zeros in for items that aren't there. Okay, it's just a matter of going in and updating that once I actually get the assignment. Okay, that said, last week was a review of financial accounting. Now we're going to actually dive into our managerial accounting. Okay. Um, so we covered this last week, but another recap. Remember, financial accounting that you've been doing up to this point, that's concerned with reporting that financial information externally, all right, to your stockholders, your creditors, the SEC, the public in general, okay? Whereas in this course, we're going to be um, focused on managerial accounting. This is concerned with your in-house reports. So how are you doing financially? What are your projections for the future? How do you want to budget your money? Things like that. Okay, they're your in-house decisions. Um, we need to, in order to be good cost accountants, we need to assign our costs to specific cost objects. Okay. Um, this type of accounting, managerial accounting, we also call it cost accounting. It's very commonly used in manufacturing companies, but any type of business can use these concepts. Okay. Um, we used specific cost identification when we were doing financial accounting. Remember that every time we have a transaction, we have to assign that to a specific account. Okay. At that time, we were using it to identify our financial position and things that had happened throughout the year. In this class, we're more going to be using it for predictions, so what happens in the future. And also, we're going to be using it for decision making. Okay, so the first thing we're going to do is um, identifying our types of costs. Okay, so the first two vocabulary type things we're going to make you aware of is direct versus indirect costs. Okay, our direct costs are the costs that can be traced to a unit of product. Okay, So, for example, if you're making cars, the cost of the aluminum that goes into the car body, the cost of the tires, those are direct costs, okay? You can trace that specific cost directly to a particular car or a batch of cars, okay? On the flip side of that, we have indirect costs. Those costs can't be easily and conveniently traced to a unit of product. So, for example, again, with our car example, the mortgage on the factory building where we make all our cars all the time, we can't really trace that to one particular vehicle. We need to find a way to spread it out over our whole business. Okay. So common costs are a type of indirect cost. They support a bunch of different divisions or product lines, things like that. Okay. Right now, you just need to know the terms. We will work on how we use those later on. Okay. All right. So when you're manufacturing your own products, you're going to have direct materials. The materials you use to make your products are direct labor. Those are people working directly on the line to make your product. And then we have the overhead. So that's all of those costs that are kind of nebulous and we're not sure how to assign them yet, but we're going to figure it out. Okay. So um, our direct materials, we start off with raw materials, whatever those may be, and they become part of the product. Okay. And they are conveniently traced directly to it. Um, Hi, sorry, I had to pause the recording for just a second, um, because I felt like it was getting too loud in here. Um, you can probably maybe see without the blue screen that I've taken my bird out of the so if you see him popping in and out of the screen, again, I hope that's not too distracting, but at least it's quieter now. Um, yeah, it's an exciting Sunday here at the Rucka household. Anyway, so I left off talking about direct materials, direct labor. Those are our labor costs that are easily traced to individual units of product. That can either be a batch or it can also be an individual one item. Okay. All right. So the manufacturing overhead, remember that is sort of a bucket that we put in all the costs that are difficult to trace to a unique batch of product. Okay. It includes everything except the direct materials and the direct labor. All right. It can be the indirect materials. All right. A bucket of bolts that we use in like every single product line, or um, it could be the cost of our advertising department. Again, that's spread over the entire company. Okay. We are going to figure out how to assign those costs, but as a general rule, they're difficult to trace to an individual product. Okay, here are some examples of manufacturing overhead items. Okay, um, with manufacturing overhead, we only include the indirect costs that are associated with operating the factory, and those are included in manufacturing overhead. So, like your line manager. Okay, so our next um, vocabulary item is prime cost versus conversion costs, right? So our direct materials and direct labor are going to be prime costs. Some of our direct labor plus the manufacturing overhead are considered conversion costs. All right. So our non-manufacturing costs are broken out into our selling and our administrative. Okay. So the selling costs are our sales department. All right. Those costs necessary to secure the order and deliver the product. They can either be direct or indirect. Okay. And then our administrative costs, that's the upper management, our clerical department, HR, things like that. Okay. Um, More vocabulary. We have our product costs. Okay. I know this is a lot of terms without actual examples. Okay. We are learning like the language of managerial accounting so that moving forward, we are all talking about the same thing. Okay. But apologies for the format here. Okay. So, anyway, product costs, those are all the costs that are involved in acquiring or making a product. Okay. These product costs attach to a unit of product when it's purchased or, manufactured if we're making it in-house, and they stay attached as long as the unit remains in inventory waiting for sale. And then, it becomes COGS, right? That's what happened in our financial accounting too. All right. If you're a manufacturing company, your products are going to include your raw materials, your works in process. Okay, so as you go through the process, we are placing these costs onto the item. Okay, so the raw materials we purchased, our lumber and our screws and whatever else is going to go to these things, work in process, that's when it's literally that partially completed items. Okay, and then we have our finished goods inventory. And then once we sell those items, they're going to be cost of goods sold. Okay. All right. When our direct materials are used in production, their costs are transferred from raw materials to work in process. Okay. Direct labor and manufacturing are going to be slapped on to those works in process to convert direct materials into finished goods. Okay. Once they're completed, they're going to be go from works in process to finished goods inventory. And then when they're sold, they will be cost of goods sold. I know I just said that before, but I said it before I got to this slide. So saying it again. All right. So, our product costs are going to hit the various financial statements when they're still in inventory. They stay on our balance sheet. As soon as we sell them, they are going to become costs that are reported on our income statement. Again, we learned this in financial accounting. We're just going to hit it again. Our period costs, like the selling costs and the administrative costs, those are going to hit our income statement as expenses. Okay, wait, I went back instead of forward. There we go. All right, so pop quiz. Which of the following costs would be considered a period rather than a product cost in a manufacturing company? Pause the video. Okay, if you said property taxes and sales commissions, great work. All right. So ideally, we are going to once we've gained our cost accounting skills, we are going to be able to predict cost behaviors. All right. So let's look at what these cost behaviors are. We have variable costs, fixed costs, and mixed costs. Okay. And they are what we say they are. Our terminology in accounting tends to be pretty simple, okay? A variable cost varies, all right? It is going to vary in direct proportion to our level of activity. So, for example, those direct materials that we talked about, those are going to be a variable cost, right? The more cars we make, the more direct materials we're going to use, the more money we're going to spend, okay? We usually have some kind of cost driver that cause this variable cost to grow or shrink. Okay, maybe it's the number of units we produce, maybe it's our number of machine hours or our labor hours or our miles driven. Okay, but some item, some activity that we're performing is directly tied to this variable cost. The opposite of that is our fixed cost. Okay, this is going to remain constant regardless of our changes in activity. Okay. If we're talking about a per unit basis, it would vary inversely with our level of activity. What does that mean? That means that our mortgage is always fixed. Okay, no matter what. No matter how many cars we make or how many people we hire, the mortgage on that building is going to be exactly the same. Okay? But if we want to tie that mortgage onto our items in some way, then because it's a constant amount, if we divide it by the number of cars we're making, if we make more cars, it seems like there's less fixed cost per car, right? But in reality, that cost isn't really changing. Okay, there are two types of fixed cost. There's committed and discretionary. The short version of this is that committed, you can't get out of it. No matter what you do, you're going to have this fixed cost. Discretionary means that short-term management decisions can impact these costs. Okay, so we have control over whether or not we're spending those discretionary costs. All right. If you took economics, you may have learned this curvilinear function for cost versus demand. With accounting, we like to simplify that into a straight line, and we have discovered that there's not really a material difference between this model and the reality. Okay, it just takes less time, which I'm sure we're all grateful for. Okay. Um, so we are going to be looking at this relevant range where you can see the straight line most closely approximates our curvilinear function. All right, and the relevant range of activity is our fixed cost and our variable cost together. Okay, so an example of this would be, our office space is available at a rental rate of $30,000 per year in increments of 1,000 square feet. So there would be a step up, and each 1,000 square feet would be an additional $30,000. Okay. So it kind of look like this. Okay. It's fixed. It's a fixed price within 1,000 foot increments. Okay. Here is a table that summarizes the behavior of both variable and fixed costs. Okay, hang on to this slide. It's very helpful. All right. So let's talk about mixed costs. All right, these It is what it says it is. It has elements of both variable and fixed costs within one item. Okay, so the example they give is a utility cost. Okay, there's a fixed monthly fee, but then there's additional cost based on kilowatt hours, right? So part of it is fixed and part of it is variable. The total mixed cost and any variable cost can be expressed with the equation y equals a plus bx. This might look familiar from our equation of a line back in middle school algebra, okay, where y is the total cost, a is the total fixed cost, the vertical intercept of the line, b is the variable cost per unit, and x is the level of activity. Okay, so let's see that in an example using that utility charge. If your fixed monthly utility charge is $40 and your variable cost is 3 cents per kilowatt hour, and your monthly activity is 2,000 kilowatt hours, what is the total amount of your utility bill? Okay, so we're using this A equals BX, where A is our fixed amount. Our variable amount is 3 cents times our 2,000 kilowatt hours. So in total, it's going to be $100 at this level of activity. Okay, now let's talk about decision making. All right. When we are making decisions in managerial accounting, we're usually choosing between two or more alternatives. Okay. We have to identify which costs are relevant and which are not relevant to our decision. Okay, this is one of those places where decision makers can behave irrationally. So we have to be careful when making our decisions which costs are going to be relevant. It seems simple, but people get hung up on this concept, okay? So let's take a quick look at our different types of costs and their relevance. All right, so we have differential costs. They're also called incremental cost. This is going to be the difference in cost between any two alternatives, okay? So the opposite of that is differential revenue. So that's the difference in revenue between two alternatives, all right? These are going to be relevant to our decision making, okay? Our differential costs can be either fixed or variable. Opportunity cost. This is not an actual financial dollar value cost, okay? This is the benefits, the opportunities, the choices that are given up when we decide on one alternative over another. So after you watch this video, you have a choice to make. Are you going to take the rest of the day off? Or are you going to watch the next video in this series? Okay. If you choose to watch the next video in the series, there are benefits that you can gain from that, but you will miss out on the opportunity to take the rest of the day off. There's no financial value associated with that, but there is an opportunity cost. All right, sunk costs. This is the area where I feel like decision makers can behave the most irrationally. Okay. These are costs that have already been incurred and can't be changed now or in the future, and they're irrelevant. Okay. I will take an example from my personal experience. I'm a homeowner. Okay. This year, a pipe burst. This year? Last year. Sorry. Last year in the spring, a pipe burst. Okay. And flooded our entire house and we had to get it renovated. It was very expensive. Um, there was something went wrong with the renovation, and shortly after that, we had an electrical fire. Um, then recently, also very expensive to fix. Recently, we had someone come by and inspect the plumbing and tell us that the plumbing is out of date and it needs to be completely replaced. Okay. So I turned to my wife and I said, okay, we need to sell the house. It's got way too many issues. And she said, oh, but we've put so much money into it already. That is the definition of a sunk cost. Okay. What funds you've spent in the past, you can't change that with your decision making, and they should not be relevant to the decisions you're making now. Okay. But as I said, this is an area where people tend to respond irrationally. Okay, we're going to skip past these concept checks. You are welcome to look at them in the slide deck. Okay. Um, okay, this is an example of two different presentations for your income statement. This is the traditional format that you have learned previously to use in your external financial statements. But now we are going to be working with this contribution format. Okay. You'll notice that we have split out a lot of our costs. Okay, we've also moved our selling and administrative costs up in order to calculate this contribution margin. All right. This is going to be used to do a lot of our decision making and projections. Okay, so there's a new format for you guys to learn. All right, that is the end of chapter 1. I will post this and then continue on with the other lectures. Thank you for listening in.